Apple's finishing the day lower, and I want to get on this as a particular point in this tech note. After the Greenlight Capital's David Einhorn revealed that he sold his remaining shares of the tech company, I believe on August 31st. And in a letter to investors, Einhorn cited heightened valuations and trade tensions for his decision, writing, quote, "We are somewhat worried about Chinese retaliation against America's trade policies." Rebecca, you brought that up as a note of concern for all of tech. Apple specifically, is that a concern for you?
Well, again, I'm looking more at the sector. I let my portfolio managers look at the specific companies,
okay.
But I do think it is reasonable to have a concern that we go from what we're seeing narrowly as tariffs right now to a broader economic war, if you will, Cold War. You know, things like the CFIUS bill, making it harder for companies, especially Chinese companies, to do foreign direct investment, M&A in America. The tariffs. Now we're seeing possibilities of China saying, let's buy national champions, don't buy American products, go into a Chinese coffee shop rather than a Starbucks. Eunice Yoon's reported on that. You are starting to see some more economic and qualitative steps that could hurt the U.S. And I think going after some of the supply chains with companies such as Apple is another step that could be taken. So being cautious right now, I think, is very reasonable. Again, longer term structurally, I think there's a lot to like in companies like Apple.
Jeff, do you think Apple's got more to lose from the China battle than perhaps some of the other big tech names? And is now a time to be taking profits in those with exposure to China, or do you think that's already priced in and you can use the current headlines as a buying opportunity?
I think that the trade war with China is going to get settled, probably not before the midterm elections. But China's in a hard place here. Its economy's soft. The markets are down. They've lent a lot of money. Their banks have to Pakistan and Iran to build out infrastructure, and now they can't pay even the interest on those loans. So they're looking to be bailed out, and China's having to support its banks. So I think the trade tariff is going to go away probably in the first quarter of next year. So I think those kind of stocks are buys between now and year end.
Rebecca, JP Morgan downgraded Chinese equities to neutral from overweight. I mean, their base case is a full-blown trade war. I'm not sure if we're not in it yet, but we're in some kind of a trade war.
I noticed they did that, and I also thought it was interesting that even within that analysis and that new base case, the economic hit they're estimating for the U.S. and China is actually very modest. So it's not the pure economic hit you're worried about. It's going to be the level of uncertainty that could affect corporate decision-making, whether that's new investments, new hiring. And to the degree we see these qualitative measures kick in more and more, does that feed through to consumer uncertainty or prices and margins as we head into year end?
Rebecca, the other thing that's hurting China and a lot of emerging markets, of course, is the rising rate environment.
Right.
I mean, this week, I mentioned it in the close, the likes of Taiwan, Hong Kong, India, all down 4 to 5%. China was in fact closed all week, so we'll get their reaction on Monday. I mean, is that going to weigh on U.S. growth in due course, or do you think it's just a sort of superficial move in their stock markets?
You know, emerging markets play a much bigger role in the global economy today than 10 years ago. So if the pain gets large enough, it can have a spillover effect on the U.S. Europe, I think, is a lot more exposed. The both banking and trade linkages between emerging markets and especially China with Europe is a lot greater. So it's not surprising to me that Europe's underperforming so much. But eventually, if this continues, I think it can have a feedback loop to the U.S., at least at the margin.